Okay, so next we're going to look at using your policy. One thing to beef up the values, whole nother thing to actually use the money. So we talked about earlier, right? The core benefits of a life insurance policy are safe, liquid, tax-free. And then you've got that unique loan feature. So when we hear the word loan, typically what comes to mind? Payments and interest. Now, with life insurance policies, interest does accrue on policy loans. Payments are optional. Keep that in mind. We're going to do an example here. To start, however, a great way to illustrate how policy loans work is with real estate, since many are familiar with real estate. My artwork. Let's pretend that we have a home that no matter what happens in the economy, in the real estate market, my property every single year appreciates at 5% per year. Now, if you own that home free and clear, will the appraisal value of your property appreciate by 5%? Of course. If you have a loan outstanding, a mortgage or a line of credit, will you receive that 5% appreciation on the entire home or only the remaining equity? The entire home. Regardless, if we have a loan outstanding, so if we own it, or if we have a loan, does not matter because that 5% will continue to occur on the entire property. The thing is, if I have a loan, interest, at whatever interest rate it is, goes to the lender, typically a bank. Now, how this works with a life insurance policy is as follows. So let's assume I have a policy with a dividend rate of 6%. Cash value, we'll assume, for simple numbers here, I have $100,000. And I elect to borrow out or loan $50,000. That means I have a $50,000 outstanding loan. There will be loan interest that is paid to the insurance company. Typically, you'll see loan interest rates with most companies fall between 5 and 6%. With that said, it is possible to leverage a policy in the same manner that we can leverage real estate in the form of using it as a line of credit. And doing so often obtains much more attractive rates than we can get on a basic insurance policy loan. But here's the thing. When I take a policy loan, if I don't take a loan, let's start there, I would receive a 6% dividend on my cash value. If I take a policy loan, what will happen here is I have the cost to borrow that goes to the insurance company, but I have that 6% dividend that's paid to my cash value and on the outstanding loan balance, meaning I continue to yield dividends and interest, the guaranteed rate and the surplus, if you go back to that section, or if you can recall that section, on my entire bucket of money as if I never touched it in the first place. So the question we'll always get here is how? How on earth and why would an insurance company do this? Let's demonstrate. Visuals always help me at least. So here, quick sample, how policy loans work. Now, on the left, we have an example of a 45-year-old male paying in $50,000 per year for 5 years. So this is a nice example to demonstrate how we can stop funding much, much earlier if we wanted to, or he can continue to pay into the policy if he wants. But you've got your $50K for 5 years. Your dividend column, you want to look at this on both examples as we progress through everything. Cash value, so going back to how to set it up, design properly, breaking even, really at year 3 in this example. Death benefit, kind of an oddball figure here, right? $1,050,000, where we came up with that figure is that generated a MEC limit of $50,000. So we were designing it really for the minimum death benefit based off of his payment. So that's the growth example, all well and good. How do policy loans work? That's the question here. How can I use the money? So One, with policy loans, let's touch on a couple of bullet points here. I can take a loan anytime, and I have complete control. Loans are typically, as I take them, not reportable as income tax. It is a private contract. The life insurance policy does not impact my credit. Nothing like that shows up. I have the word loan in there, really, because a policy loan, I've got tax benefits there. If the policy is not a MEC. If it's a MEC, different story. I will have to deal with taxes. So I take out a $200,000 loan. My question is, what is the impact of that policy loan? Cash value reduces. View the cash value really as, call it your equity that you have access to. Whatever is in cash value, that's the gauge that determines how much I can access, what is it growing by. It's important to be aware of that. So that's what the gauge that determines how much I can pull. But then I've got the death benefit here. Look what happens here. And compare it to the example on the left. What do you notice? Dollar for dollar reduction. In the example where I let it sit and grow, I had that $1,050,000. And then in this example, I borrowed out $200,000. I see my death benefit reduced by $200,000. So back to the question, how and why do insurance companies still pay me dividends and interest on my entire bucket of money as if I never touched it in the first place? Well, how is really they collateralize the death benefit. Remember, as an insurance company, a life insurance company, their first and foremost obligation is to do what? Pay life insurance claims. If I die with a loan outstanding on my policy, they are in the hook for that much less. So one way is that they collateralize the death benefit. The other way is that I have the cost to borrow, the interest. In this example, we had a 5% loan interest rate. I borrowed out $200,000. Here's my loan repayments. I can pay it back however I want. I do not have to set up a payment plan or anything like that. A lot of flexibility. But we pay back $50,000 per year plus approximately another $29,000. I paid back, call it $229,000. That was interest that went to the insurance company. If I stop there, one would make the argument, you pay interest on your own money. And you could make that argument because I'm borrowing from money I've built up, I'm paying it back, and there's an interest rate associated with it. If I stop there, this would make 0 sense. However, it's true, just like you pay interest on equity you borrow against on your home, you pay it to the lender, but if the home continues to appreciate, or I can generate cash flow to a greater degree, I'm okay with it. When I pay that loan back, look at my cash value and death benefit and compare it to the example where I just let it sit and grow. And what do you notice? Cash value and death benefit is 100% restored to exactly what it would have been as if I never touched it in the first place. Another way to put it is that there is no lost opportunity cost here. So a lot of times what individuals will do, this is really popular among real estate investors, where instead of just banking money in cash or purchasing more property by leveraging what they have in real estate and the equity with other property, they look at this and say, okay, I can pay money into this, always have access to it, and when an opportunity arises, I know if I pull my money out, I'm going to continue to yield the same dividends and interest regardless, and then I can acquire that property. So now I've got my policy working at work for me and also my real estate investment. And I can do the same thing with my business, paying off debt. There's a lot of good we can do with it. It's always good to look at the pros and cons. Here I'm talking about the pros and benefits. There's always drawbacks of any strategy, obviously, like the first couple years got a negative hit. But this is a nice example of how policy loans work. Now, let's touch on one more thing here. How else can we use it? A couple ways. Retirement income. So life insurance for a long time has really been used as a means to generate income on a tax-free basis. So again, if I don't trigger that modified endowment contract, if I don't lapse a policy with a gain on it, or do anything else that would trigger a taxable event, I can access that money on a tax-free basis. A lot of people will pull income out of these products in this manner. I have a death benefit. Great for legacy planning because death benefits are paid out income tax-free. Great for income protection. Maybe I've got these great plans. I take out this giant policy because I'm going to stuff it full of money for cash value benefits and purposes, and then I die. Well, now a death benefit is left to my beneficiaries. Business planning and corporations. This is interesting. We've got this term down here, executive benefits, because anyone can do this to a degree. Small businesses can do it. Some families will kind of practice the same thing. When you look at how many corporations use cash value life insurance, let's just demonstrate role play real quickly here. Let's say that I own a company and you are my employee. So you're working for me and you're making, say it's $100,000 per year, whatever the amount is. And I say to you, Joe, we're going to take out a life insurance policy on you. So you may have to go through underwriting, blood and urine, you've got to sign some paperwork, potentially. I'm going to take this life insurance policy out on you and I'm going to pay it. I'm going to own it. I'm going to be the beneficiary. If anything happens to you, the death benefits are paid to my company. So how do you feel right now, Joe? I'm taking this life insurance policy out on you, paying for it, but if anything happens to you, I cash in. What's the catch? Well, the catch is you, Joe, I'll say to you, if you stay with the company, if you stay with me for 10 years, maybe it's 20 years, let's say age 65 until you retire, if you don't leave me, I'm going to pay you a retirement benefit, income during retirement. Call it a pension that we create internally with the company. I know the word pension is not compliant, but we're going to use that for this example. So if you stay with me, you receive that benefit. Now, what I'm going to do is I've built that policy up over time by funding it. And as the owner, I had access to that cash value all the way through. I can use it to invest in my business, financing, whatever it might be, clear off debt. But at retirement now, I want to make sure I've got enough cash value in here to satisfy the promise I made to you. You retired? Thank you for your years of service. I'm going to pay you a retirement benefit, which I'm going to pull from the cash values of that policy so it does not impact my death benefit, my balance sheet or my income coming in from a company, and that's how I'm going to pay you that income, that retirement benefit. And then eventually, if and when you kick the bucket, we'll always ensure that a death benefit's intact to flow back to the company and recover the costs. So a lot of corporations will do that. Oh, by the way, the catch is if you ever leave, then you do not get that retirement benefit. Company retains the cash and can keep it, can elect to transfer the policy to another executive. A lot of professional sports teams do that kind of stuff actually, which is interesting. But it's interesting where corporations do this, big corporations and such, but you don't have to be a big corporation. We've done it for small businesses. Partners do that sometimes. A lot of good you can do. So one other thing we wanted to touch on here, kind of a neat, oh, I didn't know I could do that. You ever like when you see that stuff? I do. Is in respect to lump sum payments. So a lot of times people are attracted to a cash value life insurance policy, but they are not attracted to the idea of having to make payments for the rest of their life. So you can actually set up a policy where if we have a lump sum of money, we can move it into the policy over a short period of time. So here's someone with $1 million that we move into a policy over 4 years. Yellow represents the break even. You do have that initial hit. That is the drawback there. Death benefit, $7 million. The purpose of that gave him a MEC limit of $250,000 per year. Annual internal rate of return, funding it, nothing after year 4. Cash value continues to grow. The death benefit drops. We didn't touch on this in any of the other examples. After year 7, that has to do with that MEC law. So another name for our MEC limit or MEC test is the 7-pay test. Has to do with the first 7 years of a life insurance policy, or call it the vice grips from the IRS, are very tight on life insurance policies. After that, we can drop the death benefit and not have to worry about a taxable event. and cash value continues to grow. One last thing we want to touch on, because we get this question quite a bit. What if I'm too old? Or what if I'm older? Is that going to impact things? So here we've got examples of a 60 and 65-year-old, kind of a lump sum scenario. They only want to fund it for 5 years. The 60-year-old, let's look at the 65-year-old. 100 in, break even, year 4. Let's look at a 70 and 75-year-old. 75-year-old, break even, year 5. The thing is, when it comes to age on a life insurance policy, the older we grow, the more expensive life insurance is. Naturally, yes. However, you can reverse engineer a policy. And what I mean when I say that is if we are purchasing it where death benefit's important, but cash accumulation is the goal, we hear that quite a bit. I don't care about the death benefit. A lot of times people will say that is, okay, well, regardless if I'm 32 or if I'm 75 years old, if I'm paying $100,000 per year into a policy, and we go back to the design fundamentals, premium, PUA component, MEC limit, we can minimize the premium, maximize the cash value, break-even point for a 75-year-old male, year 5. The difference an older individual will see is a lower initial death benefit. We are reducing it as much as possible. If the 32-year-old male put in $100,000 per year, he'd have about 1.5, actually about 2 million plus in death benefit for the same $100,000 per year policy, if that makes sense. So, know we covered quite a bit here. Hope you enjoyed this presentation. Reach out anytime you like, and we'll talk to you soon. Thanks again.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.